Welcome to Explain It to a Comedian. I am comedian Dhaya Lakshminarayanan.
And I'm comedian Sammy Obeid.
And I'm Robert Kosowski.
And you're not a comedian, correct?
No, maybe a budding one. I hope to learn from you.
What is it that you do?
I'm a professor of finance at Imperial College London, and I've also been the head of the department for the last 2 years.
And what's your area of expertise?
I've been focusing on alternative investments, especially hedge funds, and including some of the activities that they do, including something called short selling.
Why are they called alternative investments?
They are able to do things that traditional investment funds can't do. So they're a little bit more unconstrained or flexible. Traditional funds, for example, can't freely or as freely short sell or use derivatives as hedge funds can.
Oh, so we have alternate careers. So short selling, people talk about it all the time. What is it?
I must admit that I think you're actually better at explaining it in one of your YouTube videos that I'm thinking about adding to my future courses at Imperial. But in short, what it is, it's selling something you don't own. So it sounds a bit strange, sounds dangerous, but essentially you borrow an asset, in that case a stock, and you sell it and then you repurchase it. So it's the opposite of buying something, where you first buy something and then you sell it later on.
I once did that with my dad's car. Now, why is it so controversial? First of all, is it legal?
Yes, it's legal under certain constraints. I think the idea of making money from falling prices, maybe intuitively for a lot of lay people, sounds strange or sounds wrong, because you think of what would happen if you sell and then things get worse. But of course, if one takes a step back, one could ask, should we therefore ban any form of selling? And so there are good reasons for it from a theoretical economic point of view to be there and allowed, because it helps information to be reflected in prices. And we want sometimes good news and sometimes get bad news to be reflected in prices. So in principle, it has a useful function to play in markets.
Have you ever short sold before?
Yes, I've had a chance to short sell. So indirectly, I've had one foot in the private sector before taking on the role that I currently have. And I worked for a $30 billion asset management firm that also engaged in forms of short selling. So I had a chance to see it from close up as well.
Now, short selling, does it have anything to do with the movie The Big Short?
Yes, it's actually a very good way of thinking about it. I thought that over the last 20 years or so that I've been in the profession, Hollywood films have been made about most aspects of finance, most crises. And the idea of The Big Short specifically was about the housing market and some products associated with that. Specific derivatives. So that's a little bit more involved than the typical short selling that we think of, like short selling stocks. It's more related to derivatives that then are also sensitive to things falling.
I never watched the whole movie. Did it end well for them?
It ended well for some people. For one of the speculators, it didn't work so well for the homeowners, the banks, and society at large.
Okay. So then there was a lot of dangers of short selling.
There are some dangers associated with short selling. Yes, so there are various forms of short selling. So there's a very colorful metaphor, for example. There is a technical term called naked short selling.
Ooh.
Oh.
Exactly, yeah.
Has
so
there
a
been
visceral
a movie
reaction.
made about that?
I don't think we can watch that movie. Yeah.
That sounds wrong, and it has been banned. So in that case, there are therefore sort of various degrees of various types of short selling, various conditions. Of course, you could think of market manipulation, and there are laws against that.
Are they naked because they sold their shorts?
Ah.
Yes, when the tide goes out, You know, you see who's not wearing any clothes. So literally speaking, in short selling, you can lose money from short selling, of course. As
You can lose your shirt.
You can lose your shirt and your shorts. So, specifically, what is very unusual, and you again, Sammy, illustrate that in your video very well. It's strange to think that you can actually have unlimited losses from short selling in principle, because prices, when they go up, that's bad for you as a short seller, and there's no limit.
Well, the video we made actually declined in value, so we ended up selling it. But so I understand there's been, like, you know, with the lockdowns in the last few years, there was a kind of a relationship with short selling and some issues with that. I know you've talked about that in some of your work.
Yes, exactly. So we did a study on shorting a few years ago before the lockdowns, and then as a department at Imperial, we got together and we thought we would like to do some research that's policy relevant, so of wider relevance beyond finance. And then we thought that we should look at the short selling ban, because during the global financial crisis in 2008, there was a short selling ban, and research had been carried out on that. But there hadn't.
And was that a complete ban, by the way, on any kind of short selling, or just a lot of regulation?
So specifically, certain countries around the world for stocks, but it was very wide. What was fascinating in 2020 was that not all countries that did it in 2008 did it in 2020. So maybe there was some learning. So that sort of piqued our interest. But what was also interesting is then that we realized that there hadn't been a theoretical model, a theoretical understanding why the short selling bans could be good. So we called the paper, and here I want to give credit to my co-authors, Pasquale, Dimitris, and Nick. We called it the double-edged sword of the short selling ban. So in fact,
What is a double-edged? Whoa,
Yeah,
whoa,
wow.
whoa! Hey, whoa!
Okay. How did you get through the security?
Security.
With that?
Our security is pretty weak.
Yeah.
Exactly. I was actually surprised that at St Pancras in London they didn't bat an eyelid when I put it into the security machine.
Well, here back in the day, they used to all have those.
Yes.
So this is actually a proper double-edged sword, as you see, right?
Oh.
There's
Two
the
edges.
blunt
Yes,
edge.
two edges.
And so what we were able to show initially, first theoretically and empirically, is that there are certain conditions under which a short-selling ban could play a positive role, which wasn't really what we had anticipated initially, just intuitively, because a lot of countries stepped back from a ban. So to give you an example, in Europe in 2020, it was only 6 countries, so Austria, Belgium, France, Greece, Italy, and Spain that did it. Others, like the UK and Germany, for example, Poland, several others, did not have a ban in 2020, although they had one in 2008. So that was very interesting. And so we then had some empirical predictions and some theoretical predictions, and they were very strongly upheld in the data, which was very exciting for us.
What were some of these predictions?
So the main predictions that we had were on the conditions under which short selling bans could play a good role. And one of the predictions was, in fact, that a ban could be good if there is a relatively low percentage of informed investors in markets. And the intuition for that is that in the model, a lot that is crucial is how the market functions. And so if we take Dhaya, for example, as the market maker, and Sammy as the informed investor, and me as the uninformed investor, of course, Dhaya would prefer to trade with me rather than with you, because she's more likely to end up on the wrong side of the trade. And so the intuition as a result is that Dhaya would set lower prices when there are more Sammys and fewer Roberts in the audience. Yeah.
Also, you have the sword, so I would trade with you.
Exactly. And so not to be outdone, I actually brought a second prop, which is a lemon. And
That was a
many
grenade.
how many edges does that lemon have?
yeah, just one. The metaphor, I guess, a lot of people can relate to this. So a lemon, the origin of this metaphor comes from the market for lemons. So it's a famous paper from the 1970s by Akerlof. And so, as you know, in the United States, a lemon is also a term for a bad car as opposed to a peach. And so the intuition there is that you have adverse selection. So if people can't distinguish between them, the market may be dominated by lemons because the people with peaches don't get the prices they want and exit the market. So that's, in a sense, a situation where there's adverse selection. So Dhaya would protect herself against informed investors like yourself by setting lower prices. If there's small Roberts that are uninformed, that may create conditions under which the effect would be better. So the basic result is, if there are a lot of informed investors, the impact could be worse of the short selling bans.
And if life gives you lemons,
make lemon juice.
Short sell.
Yes, exactly.
Question about what you just said. What about this kind of the market maker and who they're selling to and the price? Does this play into information asymmetry at all?
Exactly. So that's a very good way of thinking about it. So there would be an information asymmetry between the market maker. So think of yourself as the car dealer that has the same model, say a BMW or a Ford, and you, of course, are willing to have one ask and one bid price at any point in time for the same type of car. But there's an asymmetry between the buyers and sellers in markets, and also potentially where Sammy might be very informed about a particular stock, you take a risk by trading with him, and you want to protect yourself by adjusting the prices of your inventory accordingly. So there's a very clear analogy between, say, stocks and cars in that sense for this information asymmetry.
Do you drive a car?
Yes.
Oh, is it a lemon or a peach?
It's at the moment a peach.
At the moment, you plan on putting a lot of mileage on it, and
yes, it could turn out to be a lemon at some point, but for now we've taken very good care of it.
Well, good for you. I know you speak a lot about differences on differences, or DID.
diff on diff?
Diff and diff, differences and differences. It's a methodology that's actually quite commonly used in other areas of science and medicine. So a lot of us as lay people, we can relate to medicine. Incidentally, yesterday I had dinner with some Dutch friends of mine that live here, and they mentioned to me Wim Hof. You may have heard of Wim Hof, the Iceman that's into cold water swimming. And there was a study of the effect of taking cold showers, for example, on health outcomes. So again, you want a difference in difference approach. You want a control group that takes the cold showers or starts to take them. The one that I read, the study was 30, 60, 90 seconds, and one that doesn't. And then you want to observe the effects. And that would be one way to control for differences between the two groups. Taking that now to our example of short selling, we had countries that instituted the bans and countries that didn't have the bans, and that allowed us quite nicely to compare the differential impacts of the bans.
And so, in terms of diff and diff, how do you say it?
Diff and diff. So.
Diff and diff.
Yes, like chip and dip.
Yeah, similar.
But there's two diffs. But the diffs are different.
How do you differentiate between the diffs?
So what we do is we have countries that instituted the ban. So I mentioned the 6, and then countries that didn't. And we have a look at then what were the key features that we care about. So one key feature that we care about would be liquidity. And so one measure of liquidity, of course, there's many different kinds of liquidity, right? But one of them would be how, when you think of a market for cars, how many cars are in the yard, right? So if you wanted to buy a particular car or sell a car, how many buyers and sellers do you have arriving? And sometimes that's also reflected then in the difference between the ask price and bid price. So if I'm a dealer that's more likely to buy a car from you, Sammy, and not be able to offload it later on, I may give you a bid price that's very low, and then when someone else comes along later, a very high ask price. So the bid-ask spread gives a sense for the liquidity in the market. And we look at what is the effect then on the bid-ask spread for countries that had a ban and countries that didn't have a ban. And then importantly also, leaning on our theoretical model, we look at what's the effect of this institutional ownership, you know, the proportion of informed Sammys versus uninformed Roberts, say, in the market, and whether it goes in the direction that our model predicted.
Can regular people just short sell?
There are some restrictions. So typically when you sign up for a brokerage account, you'd be asked how much experience you have in different assets and trading strategies. And then, of course, to protect us, the broker wouldn't allow us to do things that we don't have a lot of experience with or expertise in. But under certain conditions, regular people can also short sell.
How does one identify when is a good time to short sell?
So that's a very good question. So fundamentally, one way of approaching it would be through fundamental analysis, studying the asset really well. In financial markets, there's also maybe a more systematic approach to it, which is not necessarily fundamental, but more maybe quantitative variables. So you may have heard of famous short sellers, for example, behind Muddy Waters and others. But there are also quantitative investment funds that don't look so much at reading a lot of text and documents, but they have some metrics that they use in order to decide whether they want to short sell. They may also want to protect their portfolio. Let's not forget that when you short sell, you benefit from falling prices. So in crisis times, you may want to have some shorts in your portfolio in order to protect your portfolio against declines in prices.
Do some firms just say, we're not going to do it, no short selling at all, long only? And why would they do that?
That's a good question, yes. So some firms decide not to do any short selling. It's part of their investment mandate. So they are just long-only investors. That may also have to do with the investors that they can attract, because to short sell, one needs to register as an alternative investment fund. And that, again, imposes some restrictions on the investors one can accept. And there are, of course, also risks associated with short selling. So it's an additional effort to do it well, do it correctly, and requires expertise that not everyone may have.
Robert, why do we need a theoretical model? Why can't we just compare liquidity and performance measures for the banning and then the non-banning countries?
This is a very good question.
Thank you.
Incidentally, we had the honor to listen to 3 Nobel Prize winners yesterday here at the conference, and they are very well known for their theoretical economic research. So we could more broadly ask, what is the purpose of theoretical models? And the way that maybe as lay people we can relate to this is just to abstract away from economics and think about medicine, our own bodies. So if you think of certain diseases such as cancer, for example, that unfortunately affects a lot of people, sometimes we need to understand the biological pathway before we can look at the data. Because if we just look at the data without understanding the biological pathway, we might find certain dependence or certain correlation, but there is no underlying causality. And then, of course, there are also issues where we understand the biological pathways, but unfortunately, the disease or the incidence is so rare, very rare cancer, that we can't actually with statistical confidence say that it is indeed the biological pathway. But without the model, we can't even start to understand what the pathway is and whether it is statistically significant.
So you kind of mentioned this earlier, but if we're worried about prices dropping, why don't we just ban all selling?
I think that's a very good question and very interesting idea to consider. I think the answer is that if we think through it logically, the market would essentially evaporate. So if there is no selling, there can't be any buying. So we need always a buyer and a seller. And fundamentally, what buying and selling does is it takes the information from the people that were buying and selling, whatever was their motivation in the back of their mind, and reflects it in the price. And so the price can then be observed by others and they can get some information about what the situation is, what is happening in markets, and what the, say, economic circumstances are. And that's only possible if people can buy and sell.
So basically, stop crying, play the game. Play the game. It's like my coach told me.
What did you play?
I actually played in stock market trading
Oh,
in high school.
shortstop?
Yep, I was shortstop. So if it's been seen that bans on short sellings may not be the best thing for financial markets, why did some countries institute them in 2020? Could it have been for political reasons?
Possibly. Very good question. So sometimes public policy may be driven by political considerations and not by rational economic analysis. So imagine if the bans were found to be ineffective from a theoretical point of view and empirical point of view. What do you do as a politician when the crisis happens and you know you're relatively powerless? Well, sometimes politicians may want to be seen to be doing something, even if it's ineffective. So we found it very fascinating that in 2020, fewer countries instituted the bans than in 2008, which means there's some learning happening. But why did those 6 countries that instituted the ban in Europe do so? Well, they may have been driven by political considerations because they wanted to be seen to be doing something. Our evidence suggests that whatever they did didn't really have an effect on markets, but that may not have been evident to the layperson, the electorate, the average person, and they may have been seen to be doing something. There's also an analogy with lockdowns and pandemics. Even if we know that lockdowns are relatively limited in their effectiveness, especially in the long term, and there are also costs to them, politicians may feel powerless, but for political reasons consider the lockdowns because they give them the opportunity to be seen to be doing something. And so we need to bear that in mind, that our analysis can inform what is rational, what is optimal, but there are always political considerations which might be driving policy making.
So you're suggesting that we might not be able to trust our politicians all the time?
I think that's a very plausible hypothesis.
So if you're not into finance, or you're not a professor, you're not a student of finance, you're not an investor, why should you care about short selling? How does it affect the average person?
It affects the average person in 2 main ways. One is that financial markets, if we want it or not, affect the economy, affect our jobs. And if there's misbehavior or manipulation in financial markets, sometimes crises can occur or can propagate in ways that are more extreme. So we need to understand the roles of short selling in this transmission mechanism, because they affect whether we have a job or not and how many jobs there are out there at the end.
Thank you so much. And I appreciate that you brought a lemon with lots of liquidity in it.
Now you're just being sour.
We have to wrap up soon, but Sammy, do you have any questions?
Well, I just want to know, so, you said there's a lot of ways you can determine when's a good time to short sell. And you also said in crisis times. So you would often say like a bear market, correct? Is that like a good time to short sell?
Possibly just before the bear market.
Right before the bear market. So like a cub.
Exactly. So when the bear is still a cub, then that's when you want to identify it, and that's a good time to sell.
Pre-bear.
Pre-bear, exactly.
Before we wrap up, I noticed you put the lemon away, but you kept the sword. Is there any reason for that?
No, there's no particular reason. The sword, however, also reminds me of the fact that our paper speaks more broadly to policy and how to have evidence-based policy making, and that's what we hope to also inform with this paper, because when the bans were instituted, to our knowledge, no study had been carried out about the pros and cons. So what we hope to say, and that's nicely reflected in the sword, is that before policymakers make important decisions, maybe they should consider the sharp and the blunt edge of regulation and involve some academics to help them inform their policy making before decisions are made.
Amazing. Do you have anything that you want to leave us with in terms of a summary of your research or your most recent paper?
So maybe just to summarize the paper in 3 metaphors. So one metaphor, as we mentioned, is the lemon, the issue of adverse selection. So in our model, we find that if there are information asymmetries, the bans could actually have a negative effect. Secondly, what we also find is that the bans on average didn't have a beneficial effect, and that's the metaphor that is related to, say, the horse bolting from the barn door and us then closing the door after it has bolted. So we found that the bans were instituted at the peak of the crisis, but that's when most things had already happened and the bans didn't really have a beneficial effect on average. And finally, the third metaphor, coming to the sword, regulation always has a blunt and a sharp edge, and we need to think carefully, theoretically and empirically, about regulation before putting it in place. And it has bigger consequences and bigger relevance beyond finance when we think of pandemics and lockdowns. There is a similar discussion about how to respond to past or future pandemics. Have a plan, think of the blunt edge, the sharp edge, and then follow the plan when the crisis happens.
So maybe you're saying the government shouldn't be too short-tempered.
It should be level-headed.
Thank you for spending this time together and your summary. It was quite a nice short story.
Can I have this?
Yes.
Can I have that?
Thank you very much.